Despite all of the noise and all of the headlines, equity and fixed income markets performed exceptionally well in the third quarter. This was on the back of what we're calling a new economic as well as a new market cycle. If investors only focused on the headlines, they would have come to the third quarter with a negative view. However, what we saw was economic data that has actually improved as the quarter moved on. Now, this isn't the case across the board. We did see negative GDP growth for the second quarter in Canada, but that was more of an aftershock given the tariff tantrum that we saw earlier in the year. As we look ahead, some of the leading indicators that we're following are saying that things are improving. And this improvement in the economic data in the United States as well in Canada has led to stronger equity market performance as well as solid fixed income performance. Within the equity markets, what we saw was a continuation of the second quarter rally into the third quarter, and that has resulted in equity markets in the United States, Canada, and around the world performing quite strongly year to date. Now, this has been driven not by the headlines, not by tariff fears, not by fears of a market top, but rather by the fundamentals. And by fundamentals, what we mean are earnings, profits, and growth. We've seen corporate results in the second quarter come through with a very, very solid 11% year-over-year growth rate, and we believe this is going to continue for the third quarter as well as the fourth quarter results. This, again, not the headlines, is what has been driving equity market performance higher in Canada, in the US, and other areas around the world. When we look at fixed income, this too has been supportive of the equity markets as well as the broader economy. The big news for the quarter was that the Bank of Canada as well as the Federal Reserve both chose to cut their respective benchmark interest rates by a quarter point. In Canada, that took our overnight rate from 2.75% to 2.5%, and in the United States, the federal funds rate from 4.5 to 4.25. But we're not done here. We believe that the Bank of Canada and the Federal Reserve might have one, if not several, cuts remaining through the remainder of this year and into 2026. This is supportive not only for fixed income markets, but allows equity market valuations to push higher, as well as reducing the overall cost of capital, driving profit margins, and coming back again to strong earnings growth. So as we look forward into the remainder of 2025, we believe that this rally can continue to extend itself. Notwithstanding volatility that could pop up at any time, what we're seeing is a market environment that is closer to early cycle as opposed to late cycle. Fears of a recession, they're behind us. Fears of stagflation, they're not existent. What we're seeing is a strong environment, both economically, as well as from the equity market perspective and fixed income market perspective that should benefit investors over the course of the next 12 months.